Good morning, children. This is part 2 of the chapter Generally Accepted Accounting Principles, that is GAAP. In the previous part, we did the types of generally accepted accounting principles, out of which we have discussed accounting conventions in detail. In this part, we are going to start with accounting concepts, which is also known as accounting assumptions. In order to make the accounting language convey the same meaning to all people and to make it more meaningful, most of the accountants have agreed on a number of concepts which are usually followed for preparing the financial statements. These concepts provide a foundation for accounting process and are known as accounting concepts. So accounting concepts basically are the principles or the concepts which are usually followed by all the accountants, all the organizations for preparing the financial statements. Let us start with the various accounting concepts. There are 14 concepts, out of which 7 I have discussed in this part and rest of the 7 will be discussed in the upcoming video. So the first concept discussed here is going concern concept. Basically, according to this concept, it is assumed that a business is set to continue for an indefinite period of time. Indefinite period means whenever a businessman or an owner sets up a business enterprise, he is not really very certain that his business is going to last for 1 year or 2 year or 3 years. No, because he has set up the business, he will also assume that business will flourish and it will continue for a number of period, for a long number of years, which is indefinite, which is not certain, which is not possible to measure exactly. So this is the concept which states that a business enterprise is expected to continue for a long period, and therefore all the accounting, recording, classification, etc. are done keeping this concept in mind. As per this concept, it is assumed that the business will continue to exist for a long period in the future. It is on this concept that we record fixed assets at their original cost, and depreciation is charged on these assets without reference to their market value. Because we are assuming that the business will continue for a long period of time, which is not definite, so therefore, according to this principle, whatever fixed assets we are purchasing, fixed assets, as we have discussed in the terminology chapter, that fixed assets are the assets which the owner or the business purchases for use in the production and not for resale. For example, plant and machinery, land and building, your furniture, your tools and equipments, etc. So it is due to this principle that these fixed assets are recorded at the price they are purchased, that is at the cost price, and year after year, with the passage of time, with the usage, whatever the value is reducing in these assets are deducted out of it as a depreciation. As we have discussed in the previous part, that depreciation means a reduction in the value of fixed tangible asset due to passage of time, due to usage, etc. Because of this concept, the full cost of the machine or any asset would not be treated as an expense in the year of its purchase itself. Rather, the outside parties enter into long term contracts with the enterprise, they give loans, they purchase the debentures and shares, etc. Why? Because it is according to this concept that it is assumed a business will continue for a long period of time. Therefore, a business is able to have or take long term loans. People invest in such organizations because they also know that it will continue for a long period of time. The second concept is consistency concept. Consistency has been derived from the word consistence. That means it's something which is certain for relatively over a period of time. So consistency concept states that whatever rules, whatever method, whatever principles, whatever regulations a business or an enterprise is following it should be consistent over a longer passage of time. It should not keep on changing from time to time. For example, when you reach the practical chapters, you will study a practical chapter as depreciation. For calculating depreciation, there are number of methods: straight line method, written down value method, annuity method, etc. So this principle states that the method which you are following should be consistent. It should not be so that in this present year you are following straight line method, next year you change to written down value method, then next year you change to annuity method, then again straight line. No, this should not be done. This principle states that whatever principles, rules, methods the organization is following, that should remain consistent for a relatively longer period of time. That means it helps in making the results comparable. A very layman's example: if your unit test 1 we take for 25 marks, and if unit test 2 we take for 50 marks, and in unit test 1 you scored, let's say, 50%, and unit test 2 you scored 50%, but since the maximum marks is different, unit test 1 is for 25 and unit test 2 is for 50, so we cannot compare on the basis of marks. Why? Because the parameters are not the same. So therefore consistency concept states that whatever methods etc are being followed, that should be consistent. Now it doesn't means that we cannot change, we should be rigid, it should be outdated. No, this concept states that if the organization feels that the change in method is necessary for betterment of the organization or for better recording of books of accounts etc, then only the methods etc can be changed. Otherwise, unnecessarily the method should not be changed, so that the results are prepared in a proper manner and they are comparable. As you can see, it states that accounting principles and methods should remain consistent from one year to another. These should not be changed from year to year in order to enable the management to compare the profit and loss account and balance sheet of different periods and draw important conclusions about the working of the enterprise. But if the accountant feels that change in a particular method will lead to the better disclosure of profit or financial position or better recording, then the change method can be adopted. However, the nature and effect of the change of method for the change must be stated very clearly by way of footnotes. That means which method you are changing and why you are changing, the reason and the method should be disclosed by way of footnotes. So this was consistency concept. The next concept is accrual concept, or we can also call it as mercantile concept. Accrual concept states that in a business organization, while recording or while preparing the books of accounts, we will record all the current year transactions. That means all the transactions related to the current accounting year, whether they are in cash or not. If you have purchased anything, if you have sold anything, irrespective whether the payment has been made in cash or not, but if it is relating to the current year, then you will record. And if there are transactions for which you have paid the cash but it is not for current year, then it will not be recorded. So accrual concept states that we will record only and only the current year transactions, whether they are in cash or they are on credit. In this concept, revenue is recorded when sales are made or services are rendered, and it is immaterial whether cash is received or not. The moment we make sales or the moment we make revenue, whether we have received it in cash or not, irrespective, we will record it. Similarly, according to this concept, expenses are recorded in the accounting period in which they assist in earning revenues, whether the cash is paid for them or not. That means, according to this concept, in case of expenses also, we will record the expense in the year to which it is related, irrespective whether we are paying it in cash or not. For example, if you have paid rent 50,000 for this accounting year, the entire 50,000 will be recorded as a part of this year's expense. But suppose if you have paid 60,000 rupees in current accounting year, out of which 10,000 is related to next year, so this 10,000 will not be treated as an expense because it relates to the future year. The next accounting concept is accounting entity concept. Accounting entity concept, here entity means the identity. So, and it is also known as business entity concept. So this concept states that according to the rules of accounting, the owner or the businessman and the business are two different identities. The owner or the businessman or the proprietor and the business are two different identities. What belongs to the business does not belong to the businessman. What belongs to the businessman does not belong to the business. And it is because of this reason that the money which the owner invests in the business is termed as capital, and since it is the money of the owner but has invested it in the business, therefore it is treated as a liability for the business, because this money does not belong to business, rather it is invested by the proprietor, and the business needs to return it back to the proprietor. Therefore capital is treated as a liability. So according to this concept, the business is treated as a unit separate and distinct from its owners, creditors, managers, and others. Business unit should have a completely separate set of books, and we have to record business transactions from the point of view of the firm and not from the point of view of the proprietor. While we recording books of account, while preparing books of account, we record the transaction from the viewpoint of the business and not from the viewpoint of the businessmen, and therefore the amount which is invested by the proprietor is treated as the liability, as the capital for the business, because this is the money which it will be returning back to the proprietor. Therefore the capital is treated as a liability, and timely interest is also paid on that amount because it is kind of a loan. Amount withdrawn by the proprietor for his personal use is also treated as drawings. The amount which the proprietor withdraws out of the capital for his business use, that is treated as drawing, since they two are the different identities. It is because of this concept that the personal transactions, properties, investment, etc. of the proprietor is not mixed with that of business, because business and businessmen are two different identities. So this was accounting entity concept. The next concept is money measurement concept. Very simple concept. It states that only those transactions will be recorded in the books of accounts which are capable of being measured in monetary terms. If you remember, while discussing the meaning of accounting in the very first content video, we discussed the meaning of accounting, that accounting is the process of recording, classifying, summarizing, analyzing, and interpreting financial transactions in a chronological order. Financial transaction means those transactions which can be measured in terms of money. So this concept states that only those transactions will be recorded in accounting which are capable of being measured in monetary terms, and all those transactions which cannot be measured in terms of money, however important it is, will not be recorded in the books of accounts. As you can read, only those transactions and events are recorded in accounting which are capable of being expressed in terms of money. An event, even though it may be very important for the business, will not be recorded in the books of the business unless its effect can be measured in terms of money with a fair degree of accuracy. For example, Accounting does not record a quarrel between the production manager and the sales manager. No doubt it is very important because it is creating a dispute in the organization. But since this quarrel, this dispute cannot be measured in terms of money, therefore it will not be recorded in the books of account. So this was money measurement concept. The next accounting concept is the accounting period concept. We keep on discussing this terminology, accounting period. So this concept states that since we have studied going concern concept, since we assume that a business will continue for an indefinite period of time, therefore we cannot wait for the business to wind up to know its profit or loss or balance sheet. No, the different users of accounting information requires to have the accounting information at regular intervals. Those who are interested in the books of accounts, whether it be the government or the employee or the owner or the managers, anybody, they need to know the accounting information, what are the expenses, what are the incomes, etc., at regular intervals from time to time. So therefore this concept states that every enterprise should prepare its books of accounts at regular intervals, that is at every period of 12 months. After every 12 months, every enterprise is required to prepare its book of account for a period of 12 months, or we can say 1 year, according to this accounting period concept. Earlier, it was the rule that the period should be of 12 months. It may be either from 1st January to 31st December, or the financial year or the fiscal year, that is from 1st April of 1 year to 31st March next year, or it could have been festive year, that is from Diwali to Diwali, like that. But now, according to the latest rule by the income tax law, it is now mandatory to follow this 12 months period starting from 1st April of a year to 31st March of the next year. As you can read, the users of the financial statements need to know the results of the business at frequent intervals, that is regular intervals. Thus, the entire life of the firm is divided into time intervals for the measurement of the profits of the business. 12-month period is usually adopted for this purpose. According to the amended income tax law, a business has compulsorily to adopt financial year beginning on 1st April and ending on 31st March in the next calendar year as its accounting period. So now it is mandatory to accept these 12 months. From 1st April of 1 year to 31st March next year, it will make 12 months. So this was accounting period concept. The next concept is revenue recognition or realization concept. This concept states that when to record the revenue. That means when should an enterprise record its revenue or income, whether to record it when actually the cash has been received, or to record it when the services or the goods have been given, irrespective whether the revenue is received or not. So it determines the time or the particular period in which the revenue is realized. According to this concept, revenue is deemed or said to be realized when the title or the ownership of the goods has been transferred to the purchaser and when he has legally become liable to pay the amount. It means that this concept states that it will be assumed that the revenue has been realized, has been earned as soon as the ownership of the goods or the title of the goods or the services has been rendered to the buyer, irrespective whether he has actually paid the revenue in cash or not. But if the ownership or the title has been transferred to him and if he has become legally liable to pay for it, then the revenue will deem to be realized. For example, if you are studying in Ethel school and you have already studied from April to June, 3 months. So, irrespective whether you have paid the fees or not, Ethel will be recording the quarter fees of yours as the revenue realized. because now you are liable to pay for it. There are certain exceptions to this rule where the revenue is exception means in these cases this concept whether the title or ownership of goods has been transferred or not, these rules are somewhere accepted, or we can say exempted. So in these exempted cases or the exceptional cases, we will treat the revenue to be realized only and only if the cash has been received. The first exception is in case of sales on installment basis, the amount collected in installments is treated as realized. That means when the goods we purchase on EMI, when you purchase the anything on EMI, the ownership to you is transferred and the installment you pay on monthly basis or like this as per the terms and conditions. So the moment you pay the installment, every installment received will be considered as revenue, because ultimately the final ownership goes to you at the end after paying all the installments. So till then the enterprise cannot be revenueless. The second exception is in case of long term construction projects, it is difficult to postpone the revenue till the completion of full contract. In such cases, that proportionate part of revenue which is equal to the part of contract completed at the end of year is recognized as realized. For example, construction work, constructing a building, a dam, a bridge, a house, anything. It requires a lot of time and lot of investment. So it is impossible to record revenue and wait for it till the ownership it is finally constructed and ownership is transferred. So the enterprise cannot wait for that long. Suppose to build up a house it takes 4 years, let's say for example. So the constructor or the builder cannot wait 4 years so that the house gets completed, the ownership gets transferred to you and then it receives the money. No. In such construction cases as well, at the end of every accounting year, the percent of the construction has been completed, the amount of revenue equivalent to that will be deemed to be realized as depending on the work completed. So these are the exceptions where such rule is not applying. Otherwise, the revenue recognition or the realization concept states that revenue will be deemed to be realized when the title or ownership of goods have been transferred to the buyer, irrespective whether the payment has been received in cash or not. But the buyer should have legally been able or liable to pay the amount. So these were the 7 concepts which we have discussed here, and the remaining 7 concepts we will be discussing in the forthcoming video. So this is the assignment based on part 2. You have to answer the following questions in your register. The first question is what is meant by accounting concepts? So accounting concepts are the rules which are universally accepted by the accountants. Then you have to write short notes on going concern concept. Going concern concept basically states that a business is assumed to be continuing for an indefinite period of time, and therefore all the assets are recorded at their original cost and depreciation so charge is deducted. Then consistency concept, it states that whatever methods, rules, regulation an enterprise is following, that should be consistent over a reasonable period of time so as to make the results more comparable. And even if the change is required, it should be done only and only if it provides better preparation of books of accounts or it provides better benefits to the firm. And in such cases, the method changed and the reason for change should be mentioned by way of footnotes. The third is accrual concept. It states that only the current year transactions will be recorded whether they are in cash or not, and all the other transactions related to previous or next year will be ignored whether they have incurred in cash or not. The fourth one is accounting entity concept. This concept states that the businessman and business are two different identities, and therefore the assets and liabilities of the businessman are not the asset and liabilities of the business and vice versa. And it is for this reason that capital invested by the owner is treated as the liability for the business, because books of accounts are prepared from the business point of view and not from the proprietor's point of view. The fifth one is money measurement concept. This concept states that while preparing the books of accounts, only those transactions will be recorded which are capable of being measured in terms of money, and all other transactions which cannot be measured in terms of money shall not be recorded, however important they are. The next one is accounting period concept. Accounting period concept states that since a business continues for a longer period of time, the users of accounting information requires to know the books of accounts and the information at regular intervals, due to which an enterprise is required to prepare its book of account at the end of every 12 months. And according to the amended income tax law, it is mandatory to follow the accounting year starting from 1st April to 31st March next year. The last one is revenue recognition realization concept. According to this concept, the revenue is deemed to be realized when the title or the ownership of goods passes on to the buyer and he becomes legally liable to pay for it, irrespective whether the cash has been received or not. But there are two exceptions to this rule. The first exception is in case of construction projects where the time involved is comparatively longer. In such cases, the revenue estimated on the basis of percentage of work completed at the end of an accounting year will deemed to be realized as the revenue of that particular year. And the second exception is that goods sold on installment basis, every installment received at frequent intervals will be treated as revenue realized. So these are the 7 concepts on which you have to write the short notes. You can take the help of the video for writing them, and also which I have explained as an answer. The next question is according to which concept the same accounting method should be used each year. So the answer is concept of consistency, or we can say consistency concept. The next question, due to which concept qualitative transactions are not recorded in the books. Qualitative transaction means those transactions which cannot be measured in terms of money. So, according to which concept these non-monetary transactions cannot be recorded in the books? That is according to the money measurement concept. And the last question, according to which concept even the proprietor of the business is treated as a creditor of the business? So, this is according to the concept of accounting entity or accounting entity business entity concept. We can call it as accounting entity concept or business entity concept, because according to this concept the business and businessmen are not the same. So I hope the concepts discussed in this part is clear to you children. Do go through the video once again, revise the previous part as well, and complete all the written work in your register. Do the learning part. Thank you children.